Welcome to Partner Perspectives, a thought leadership initiative from S&P Global that brings leading institutions together to examine the trends shaping global markets and deliver forward-looking analysis that helps market participants navigate uncertainty, identify opportunities, and anticipate what's ahead. This mini-series within the Look Forward podcast spotlights our first volume, produced jointly with Vanguard, entitled Partner Perspectives, The Future of Capital Markets, Unlocking Potential Ahead. Across 3 episodes, we explore the key themes at the heart of this research, including shifts in global market structure, index diversification, fixed income resilience, and the evolution of private markets. Leaders from S&P Global and Vanguard alike discuss what these changes could mean for investors, institutions, and the broader market ecosystem. In our first episode, we're exploring the formidable forces that are driving both resilience and expansion across the full spectrum of private markets. Private equity and private credit have transformed global financial markets, attracting a broadening investor base that spans global pension funds and sovereign institutions to insurance companies, wealth managers, retail savers, and beyond, and reshaping such investors' portfolio construction and diversification. Against a backdrop of elevated borrowing costs and constrained exit opportunities, the key to unlocking the next stage of growth lies in advancing transparency and data-driven insights. I'm joined by Bill Stout, Head of Private Market Strategy at Vanguard, to discuss the optimistic but measured outlook for private equity. Although private equity investments face several near-term challenges, Vanguard's research shows that successful stakes entailing discipline, diversification, and flexibility, with liquidity and rigorous manager selection, may deliver outperformance over public equities in the coming decade. Then we'll hear S&P Global's 360-degree perspective on the state of play for private credit, considering that while private equity laid the foundation for investors stepping into private assets, private credit has seen the biggest increase in allocations and investment flows since the beginning of 2020. S&P Global Ratings' Evan Gunter and S&P Global Market Intelligence's Ilja Hauerhof's research explores how innovation is a hallmark of private credit's evolution. Let's get started. We're here to talk about Vanguard's market outlook for private equity, but before we look forward, it's essential to understand how we've gotten here. What have been the biggest shifts in capital formation and market dynamics over the last decade?
Yeah, look, this is a very popular topic, as you know, the private equity markets have grown so tremendously over the last decade. And if you look back even further, the growth is incredibly impressive. And I think that has to do with how really capital formation has evolved. If you step back, 10 years, but then go even further, and I'm going to turn the clock back all the way to when I joined the industry back in 1996. At that point, there were over 8,000 publicly traded companies in the United States. Today, it's less than half of that. The reason being is that companies are able to raise growth capital outside of the public markets through venture investing, growth equity investing, private equity funds. And so what you're seeing is this trend of companies staying private much longer. On average now, it's roughly 14 years. Versus, 25 years ago, it was about 4 to 5 years. A decade ago, 6 to 7 years. So you're seeing this evolution in terms of, capital formation. So you've seen this huge growth, about 3x over the last decade, from about $3.5 trillion to almost $10 trillion in private equity alone. There's been a significant shift also in terms of, really who's raising and deploying that capital and making those investments, to a major concentration in some of the largest private markets firms in the world, controlling a lot of that capital formation. I'd say the last, major structural shift is part of this. You're now seeing this true democratization of access to private markets. and a big uptick in terms of wealth firms offering this to individual investors, and that's caused this massive evolution in terms of vehicles for accessing private markets more easily.
That historical perspective provides strong contextualization for the near-term challenges to private equity investments. But what are the biggest risks to the asset class right now? And what strategies have you seen managers deploy to navigate these current market dynamics?
Well, look, I think outside of the typical economic risks that come and go, um, really, I think what's happened over the last really 5 years in particular is that a lot of these private equity investors who've relied on cheap debt, um, that's no longer available. So, as interest rates have ticked higher, it's going to make it much more challenging for a lot of these private equity managers to earn an attractive return on that capital. So it's no longer relying on cheap debt in fast exits, in multiple expansion, but really now a prioritization around better underwriting, improved operations, more creative liquidity management. That's really where managers need to focus going forward. I think it's really these elevated borrowing costs that have constrained managers in a number of ways. It's made it a bit more challenging for them when they underwrite these investments to find an attractive entry and exit point. Also, you've seen exit markets slow down or tighten up altogether over the past couple of years. And that's making it very difficult for managers to really monetize a lot of these investments, either through, it could be strategic acquisitions or public listings. And so it's really, been this interesting convergence of trends evolving. But one of the benefits is a true secondary market has evolved over the last decade. And so this secondary market is providing a lot of additional flexibility for both uh, GPs as well as LPs to manage their liquidity, manage their asset allocations, and really help them with managing that deployment of capital into the private markets.
Given that markets are cyclical, how does performance differ between public and private equities?
Well, I mean, the obvious is that you don't have the daily valuations in private markets. Um, so you have this difference in terms of the liquidity, the valuation methodologies, leverage, and then back to the sort of timing of exits, which can cause a big difference in terms of what the experience is for an investor in publics versus private equity. Historically, private markets or private equity in particular has outperformed public equities by 200 to 400 basis points a year over a longer term horizon. Um, you've had 8 to 10% expected returns out of public markets, 10 to 14% longer term out of private equity. And some of the drivers of that excess return are around that illiquidity premium that you're getting from private equity. It's leverage, but it's also operational improvements, which are becoming more and more important today, active governance. Um, but there's massive dispersion, and so that's something we spend a lot of time talking about in private markets as compared to public markets. It really is around not just being in the right asset classes, but it's really about manager selection. So that's really sort of where the vision or concern shift to is manager selection.
Vanguard's outlook is appropriately titled Optimistic but Measured for Private Equity, which I love. This feels like a lighthouse of opportunity in the clouds of uncertainty in today's markets. So let's get into this positive perspective. In your research, you expect that high-quality managers with reasonable fees will deliver high single-digit annualized returns, outperforming public equities over the coming decade. Bill, what factors will drive this growth?
Yeah, well, we are optimistic as you know, Molly, but we're very measured because the return drivers are evolving. As I noted earlier, no longer can managers just rely on really cheap interest rates, low cost of borrowing. Today it's really in this environment, disciplined underwriting, really understanding what you're paying for the asset is critical. But also what's becoming more and more important in this, is even prior to interest rates reaching record lows a few years ago, strong operating capabilities, what's really differentiating managers' performance today. So, we believe that if you have the right underwriting abilities, you can find managers with those capabilities in-house. Valuations still matter, but private companies continue to trade at more attractive multiples than public equities.
Mhm.
So we think that supports the case for the private equity illiquidity risk premium. But if we can find managers that really have that strong operating capability, they can deliver that alpha above the public equity markets. But I say sort of put together the opportunity in private equity today. It's not about financial engineering or market timing. It's about disciplined execution, and high quality managers really can grow earnings, manage costs, and deploy capital thoughtfully. And those are the ones that are best positioned.
Now, taking this to an existential perspective, why is manager selection and diversification across strategies, vintages, and regions important to this outlook and outcome?
Yeah, that's look, the one theme that I think I mentioned a couple of times already is that it's
Mhm.
not just about the asset class selection and deploying, but it's really about who you're investing with and how consistently. Dispersion in private equity returns remain quite wide, and really in line with where they've been historically. But really sometimes I think investors need to understand and reframe where have private equity returns been over the last decade. So looking at just 10-year IRRs over the last decade, 95th percentile, so top performing managers have returned on average 38% per year. So significant outperformance. Whereas if you look at the other end of the spectrum, the bottom performers have produced in the fifth percentile a negative 16% per year outcome. So that's a significant difference that you just don't see typically in the public markets.
Mhm.
If you sort of look at what's driving that, again, it's that deal sourcing, it's operational execution, and it's the ability to exit across these managers. But a critical part of this as well, it's not just that manager selection, it's diversification. So you need to be disciplined on that diversification by strategy. You can't just be in one single strategy. I think today what's hitting the headlines a lot is around software exposure. You need to be diversifying by vintages. So the year in which you allocate can be a very different experience from prior years. And then also diversifying by regions, because each region has their own factors impacting their economic growth and capital market conditions. So it's really that, again, disciplined manager selection, finding those best in class managers with those strong underwriting and operational capabilities, but then, being disciplined to executing in sticking to your strategy that's, again, diversified by vintage, by strategy, and by geography. That's how you build a successful private equity program.
Mhm. While the private equity industry has matured, the private market overall is innovating at scale, speed, and with sophistication. More companies are staying private for longer, and some valuations are skyrocketing with astronomical scope. Your research shows that valuations for private companies are attractive compared to public markets. We're also seeing the popularity of secondaries, like we've talked about, and other multi-fund or multi-manager vehicles rise. So, in your view, what else is next on the horizon?
Well, look, I think in addition to what you noted about the secondary market continuing to evolve, which we completely agree with, I think two other themes that maybe you hear a little bit about one, less about the other. One is around broader access. So I know there is that theme that we talked a little bit about. Wealth investors are now allocating to the private markets in a more um, meaningful way, and private markets are becoming more of a core consideration for their asset allocation. And so the vehicles have evolved to make investing and access more in line for what a individual investor really requires, whether it's your tax reporting, ability to really allocate and deploy in a more consistent manner. The ability to have some limited liquidity in these products is also important to individual investors. But the risks are also much higher. And so I think that's something that you really need to focus on access expands into the wealth channel. But then I'd say the other one, which is less talked about, is cost discipline. And even though these markets are maturing and you've seen this massive growth in private markets, fees haven't come down in line with the growth. And that's something where we see an evolution coming over the next decade. And we at Vanguard hope to play a part in compressing those fees to investors over time as well.
Bill, thank you so much for your time. It's been such a pleasure and a privilege to have you on the Look Forward podcast. Is there anything that we haven't discussed that you'd like to share with our listeners?
Yeah, so look, I think there's one thing in particular when we talk about democratization and access to private markets. These investments aren't for everyone. And
Mhm.
so when considering an allocation to private markets, really understanding the risks, including the illiquidity risk as well as the active management risk, that's something that I think we really as an industry need to do a better job of educating investors before they're allocating to these types of products.
Thank you for looking forward with us, Bill. See you next time.
Thanks, Molly.
Private equity, secondaries, venture capital, and real assets have become integral components of multi-asset portfolios for a broadening investor base. And private credit is now playing a bigger part of this transformation. These assets present new challenges for sound risk management practices as private assets are less liquid, more opaque, and frequently complex. But this is quickly changing. Investors are increasingly seeking objective benchmarks, standardized reporting, and tools that support clear and consistent analysis, attributes long associated with public markets. Here we have two of S&P Global's private market specialists, Evan Gunter, Director of Private Markets Analytics at S&P Global Ratings, and Ilja Hauerhof, Director of Quantitative Research and Solutions for Private Markets at S&P Global Market Intelligence. Thank you both for joining the Look Forward podcast.
Thanks for having us here, Molly.
Great to be with you.
Super. So let's get started. Evan, I'd love to begin the conversation with you. The focus for this episode is on the forces driving resilience and expansion in private markets. Let's get started with the big picture before we get into the details and dynamics. How has the private credit market adapted over the last decade? What exactly laid the foundation for the growth and innovation that we're seeing in the asset class today?
Thanks, Molly. So let's take a step back and talk about private markets more broadly. First of all, you've got private companies, and these private companies are getting bigger. So a decade ago, we thought it was a big deal if a private company was reaching $1 billion valuation. They were so rare, we called them unicorns. But those unicorns have given rise to decacorns, which are the private companies with more than a $10 billion valuation. And then those decacorns have given way to hectocorns, which I'll just refer to as private companies with more than a $100 billion valuation. So who are some of these private companies with more than a $100 billion valuation? We've got OpenAI, you've got Anthropic, you've got SpaceX. These are companies that we read about in the daily news. They're household names and they're private. What we're seeing is that with as much capital as is flowing into private markets, private companies can get bigger and stay private for longer. Now, part of the private markets is also made up of private companies that are funded with private debt. 15 years ago, banks were adapting to a post-GFC financial regulatory environment, and they were pulling back from some types of lending, including some of their corporate lending. Meanwhile, alternative asset managers were growing. They had cash to deploy as investors were increasing their allocations to alternatives. Interest rates were low, and this was supporting an active market for LBOs to take companies private. Private credit direct lenders then were able to carve out a niche, providing middle market debt capital that was often serving as a source of funding for those LBO transactions of private equity firms. In the lower for longer rate environment, this growth accelerated. And then it took off after the COVID pandemic. With more assets to manage, the private credit providers expanded the scope of their lending to asset-based finance and to more types of credit. So as we've seen private credit grow, we've also seen it expand to more parts of the market.
Thanks, Evan. That history certainly provides important context for us to understand current conditions for private credit. The past 6 years or so, as I mentioned in the introduction to this episode, have seen the biggest increase in allocations and investment flows, and private credit achieved annual returns of almost 10% without having any full years of negative returns, according to S&P Global's research. And against this backdrop, Ilja, your team's insights find that the 5 largest managers represent a sizable portion of the private credit market. My question is for you. What is the state of concentration risk in the market right now, and what are your expectations for growth in credit AUM with these prominent players looking forward?
Thanks, Molly. Yeah, while private equity laid the foundation for investors stepping into private assets, it's private credit that has seen really the biggest increase in allocations and investment inflows since the beginning of 2020. However, the private credit market became really highly concentrated, with the 5 largest players, Apollo, Blackstone, RS, KKR, and Carlyle, controlling a significant share of the market, which is currently estimated to be over 3 million AUM. As of the third quarter of 2025, our analysis shows that their combined credit assets under management exceeds 2 trillion. Based on our Visible Alpha consensus estimate, this concentration is expected to intensify, with the top managers' credit AUM projected to grow at a compound annual rate of nearly 13% over the next 4 years, reaching approximately 3.3 trillion by the third quarter of 2029. To put this into perspective, a recent Morgan Stanley study is estimated private credit to become a 5 trillion market by 2029, and the top 5 players would manage nearly 70% of it, according to our estimates.
Thanks, Ilja. This growth is absolutely dependent on private credit's continued innovation, and we already know that adaptation is a signature feature of private credit, which continues to reinvent itself. Evan, you touched on this a bit before, but what trends are you seeing take shape as private credit expands its traditional footprint into asset-backed finance, securitizations, fund finance, and infrastructure?
Thanks, Molly. It's not just the types of lending that we're seeing expand in private credit, but it's also the investor base itself that's expanding. Ilja was just mentioning that estimate that the private credit market could grow to $5 trillion. That's not just based on the same investors deploying new money. That also includes new investors coming into this market and investing new capital. New investors include retail as well as institutional investors. And on the institutional side, insurers have been a growing part of this market. Growing part of this market for investors. These institutional investors have led to a demand for private credit investments that were backed by hard assets or assets that provided contractual cash flows. And that's contributing to private credit's expansion beyond middle market corporate direct lending. And this expansion is going to infrastructure, to fund finance, to asset-based finance, like you mentioned, and also to large corporates and even more parts of the credit market. One thing that changed is that alternative asset managers grew large enough, with enough size and enough scale, that they could build vertically integrated platforms that span from origination to distribution. They can originate financing for assets that range broadly from royalties to asset leasing, as well as loans for aircrafts, containers, timeshares, and even more esoteric assets like music rights. Asset-based finance is finding ways to fund many diverse types of assets. And there's also some overlap between asset-based finance and fund finance. Just look at the growth of multi-strategy funds from alternative asset managers. These funds can seek opportunities and relative values, whether they're in fund finance, asset-based finance, or elsewhere. And this growth is picking up, and it's also blurring the lines between fund finance and asset-based finance.
ABF has been part of credit investment strategies for over a decade, but what I found very interesting is that S&P Global Market Intelligence data from the earnings calls of more than 50 private equity firms shows that mentions of asset-based finance surged sevenfold between 2021 and 2025. And on top of this, recent headlines have christened ABF as private credit's next big thing, the next chapter, and the next frontier. So with this in mind, Ilja, what are your expectations for the 5 largest managers? As you mentioned, that's Apollo, Blackstone, Ares, KKR, and Carlyle, to approach asset-based finance within their credit portfolios through the remainder of this decade?
Thanks, Molly. Yeah, indeed, interesting finding, right? As those executives on those earnings calls continuously and increasingly mention asset-based finance, talking about it because it's a new shiny thing, right? That they want to showcase to the investors. And I would expect them to keep leaning into the asset-based finance as the primary growth driver within the credit portfolio, because the strategy is already scaling quickly with asset-based finance AUM among the top 5 managers you mentioned, already nearly 500 billion as of Q3 2025, and has grown 25% year over year. And it's projected to compound at 21% annually going into 2029. And on that trajectory, ABF, or asset-based finance share of the credit portfolio, is expected to rise from currently 24% to 29% by 2029, with the total ABF AUM surpassing 1 trillion across those firms. A big part of ABF appeal is the greater transparency in the underlying assets, which helps investors, more clearly assets, collateral quality, and structure-specific risks, and builds trust in the vehicle. And from the asset owner's perspective, ABF can improve liquidity, by financing pools of assets, enabling more flexible capital management and easy access to funds. Tailwinds that reinforce its attractiveness, and it takes a large share of the private credit portfolios.
So we've talked extensively about the opportunity side of the spectrum. I think it's time to realign our focus to the risk angle. Evan, you're critically analyzing credit risks day in and day out in your role in S&P Global Ratings. And Ilja, you're developing extraordinary tools to assess market and company sentiment on such topics across your team at S&P Global Market Intelligence. As private markets generally and private credit specifically continue to mature, adapt, and innovate, I'd love to know from both of your perspectives, what, in your view, should market participants be watching out for? Evan, we could start with you.
Thanks, Molly. There are certain risks that are just part of the private credit market. These include liquidity, transparency, and complexity. For liquidity, the underlying assets that a private credit manager holds. So that direct lending loan, that private credit instrument, it tends to be illiquid. There's not an existing secondary market for these instruments. There are some attempts to start secondary markets for them, but it's not to the extent that we have secondary markets for bonds or for broadly syndicated leveraged loans. To match the liabilities of the funds with these illiquid assets, many fund structures and many fund managers can limit investors' access to redemptions, or they have closed-end vehicles that don't allow for redemptions. For transparency, it's a private market. We call it a private market for a reason. You don't have the same level of systemic transparency and disclosure that you have in public markets. And for complexity, asset-based finance is an important part of the story of growing complexity in the private credit market. Private credit is expanding into new types of credit. Asset-based finance is one of them. Digital infrastructure, large corporates is another. And this is leading to growing complexity in the market. It's also leading to growing complexity in the instruments themselves and in the interconnections between entities and between parties in this market. With liquidity, transparency, and complexity as risks that are inherent in the private credit market, an investor must enter the market with eyes open to these risks, and also with an understanding of their own risk tolerances and to gauge what exposure level is correct for them.
Ilya, do you have a similar perspective or an entirely different view?
Pretty much aligned with what Evan was saying. I would say that as private credit continues to grow, mature, and integrate with broader financial markets, attention should shift from identifying basic risks to understanding how those risks transform under different conditions. During periods of economic stability and robust capital inflows, vulnerabilities may quietly accumulate, remaining hidden until external pressure exposes them. Competitive dynamics and strong investor demand can sustain asset prices and obscure early warnings, signs of financial strain among borrowers. This can result in risk emerging only after a broader economic shift or performances declines rather than being immediately apparent. And additionally, the influx of new capital and participants reshaping the market practices. Lenders may gradually relax the lending criteria, such as increasing leverage or reduce protective covenants, in response to the needs to deploy funds, which can amplify the risk over time. So the movement into less established areas of private credit brings new challenges, as with asset-based finance, for example. These segments often lack comprehensive historical data or proven risk assessment frameworks. And moreover, as private credit becomes more intertwined between bankers, insurance, institutional investors, and other players, the stress spread across this financial system increases. Investors in private markets must prioritize access to detailed and up-to-date information to effectively monitor and manage those risks, especially when market conditions becomes challenging. This approach helps really bridge the transparency gap and supports better and faster data-driven decision making.
So with all of this in mind, our last question, as appropriate for the Look Forward podcast, is forward-looking. I'd love to know what structural shifts need to come into fruition for private market allocations to align with long-term objectives and risk budgets to flexibly fit the needs of the myriad of investor profiles and unlock the future growth that we've discussed in this conversation today.
Sure, thanks, Molly. So between the risks of liquidity, transparency, and complexity, I think I'm on Ilya's team with this one, that transparency could be the key to unlocking future growth. I like that Ilya was mentioning the investors' need for access to details, for up-to-date information on their investments. I agree with this. Transparency is a key to unlocking future growth in this market. In the public credit markets, you have audited financial statements, you've got market prices, and you often have public ratings for instruments. But that's in the public market. In the private market, you don't have such systemic tools of transparency and such systemic sources of a look through across the whole market. In the private market, I think if we can get new tools and new standards to support clearer reporting and more transparent communications of risks and returns, it would help to add to the level of transparency and also help to add to the level of confidence for investors within the system.
It's quite the mic drop moment to end on, but Ilya, if there's any other thoughts on transparency, I'd love to give you the last word.
Yeah, no, transparency can only be unlocked with the relevant data, right, which investors and market participants will have access to more timely data. So building kind of this stronger infrastructure centered on transparency and standardization, this will empower investors to confidently size, compare, and monitor exposures. And At S&P Global Market Intelligence, we see the next stage of growth is directly tied to improving transparency in private markets participants across asset classes and providing standardized but deeper, more granular performance benchmarks, including the differentiated strategies like asset-based finance. So allocations can be assessed against long-term goals and risk budgets.
Well, you heard it here first, folks. Evan, Ilja, thank you so much for your time. Thank you so much for joining the Look Forward podcast. Is there anything that we haven't discussed today that you would like to share with our listeners?
First, I'll start off. Just want to say, Molly, thank you for having us as a guest. It's like we're always trying to bring new insights to the market through private markets analytics, often using data that Ilja and his group provides through market intelligence. So being able to come here on a podcast like this and talk about our research and what we're finding, what we're seeing in the market, it's a great opportunity to help us share this with a broader audience. So thank you so much for hosting us.
Yes, I would like to add, first of all, thank you, Molly, for hosting us as well. And as Evan mentioned, right, so the quantitative research and solutions team within the S&P Global Market Intelligence, we cover all asset classes and provide in-depth data-driven research, including private markets as well. So for everyone who wants to read our latest publications, head to Quantitative Research and Solutions S&P Global website, or just email us qrs@spglobal.com.
And I'm going to piggyback on that one. For additional research from private markets analytics, you can go to spglobal.com/ratings/private markets.
As you've heard from Bill Stout, Evan Gunter, and Ilja Hauerhof, the key to unlocking the next stage of growth truly lies in advancing transparency and data-driven insights. This reinforces the clear message of our joint research, partner perspectives, the future of capital markets, unlocking potential ahead. This is a moment of real transition, an inflection point, and the opportunities ahead won't be unlocked by any single participant acting alone. Infrastructure, policy, data, and market practice will all need to evolve, and that evolution will be shaped by collaboration. That's what makes this partnership between S&P Global and Vanguard so important, bringing together complementary expertise to offer clarity in a complex world, with insights designed not only to inform, but to help market participants channel knowledge into action. To learn more, read the full collection of research on spglobal.com. I'm your host, Molly Mintz, and this is the Look Forward podcast. Thank you for listening.